Okay, welcome back, everybody. My name is Cecilia Skingsley. I'm managing the BIS Innovation Hub, and it's a great pleasure to chair the last panel of the day. One panel to go before dinner, which is always a bit of a challenge. But I've already spoken to my fellow panelists here, and they have all promised to be to the point, and very engaging and generally very exciting. So this will be short, 45 minutes, I would say. So we will stop not too late and you will have time to get yourself in order for dinner. So today we have discussed about the role, the big tech role in financial services, their financial connections with banks, their roles as providers of critical services to financial institutions. And now it is time to turn our attention to their role in the crypto world. And let me just, as a warm-up for you, mention a few crypto-related initiatives from big tech side. So in 2019, Facebook attempted to create Libra. I'm sure that will come back in the conversation soon. In 21, Alibaba authorizes NFTs exchanges. And last year, Instagram announced the integrations of NFTs in their offers, and Mercado Libre did an investment in Paxos. And although not yet, we have not seen many of these cases in practice, some big techs could develop stablecoin projects or also come out with decentralized finance applications. And since they operate on a global scale, we could see the possibility that they use these powers to widely establish products that scale on a multiple size. So a lot of interesting issues and complex questions are being coming out of this situation, such as how should we tackle the expansion of big techs into crypto, and what are the correspondent risks if that happens, and when it happens, rather. And what are the financial, prudential, and competition-related issues if big techs are issuing stable coins? But also, what could be their potential role as service providers in the crypto ecosystem? As I said, we have a really exciting panel here, and let me introduce them. I would like to start with Christian Catalini, who joins us on screen. And Christian is the co-founder and chief strategy officer at Lightspark, and previously co-creator of DM. I'm very happy to have you here, Christian, on screen. We hope to hear from you very soon. On my right side, I have Nelly Lang, Undersecretary for Domestic Finance of the US Treasury Department. And on my left side, I have Rupert Schaefer, who is Director for Strategy, Policy and Control at the Supervisory Authority in Germany, BaFin. And we will do this as we usually do things, 3 parts. First, some opening remarks by each panelist. I'll take the liberty of asking some questions. We'll have a little bit of panel discussion before I open the floor for questions from you. And I aim, as I said, to stop around sort of 5:20. Okay, so with that as an introduction, I would like to leave the floor to Christian and for his introductory remarks.
Thank you so much. It's a real pleasure to be joining you, even if only remotely. I will use these opening remarks to address, to some extent, what is the elephant in the room whenever you talk about crypto in 2023. 2022 was a very difficult year for the space. I mean, we've seen a number of major meltdowns, FTX, of course, the Terra Luna algorithmic stablecoin. Ironically, we had written a paper and shared it widely about the flawed design of these type of stablecoins way before that happened. But you know, as always, this has led to greater calls for more oversight, you know, frameworks that are purpose-built for crypto, But the challenge is that's likely to be only part of the solution. I'd like to kind of use these few minutes to emphasize what I think is a contrarian hypothesis on what the problem with crypto actually is right now. The space as a measurement problem. Founders, investors, the broader public have obsessed over the last 10 years about issues such as the price, the market capitalization, the trading volume of these new coins and tokens. And the issue is that these are really deeply flawed metrics. They don't track actual progress, and they've actually led to premature financialization of the technology. It's actually quite rare for a new technology in its early stages to be so closely tied to investment, speculation, trading. And these metrics also have a somewhat misleading nature, right? So they almost look like stock tickers, but the space lacks many of the same protections that have been developed over decades in the market for securities. The tokens per se may not be securities, but often the contracts around them and the way they're distributed to the public, the way they're sold, the way they're incentivized, of course, have many of the same challenges that we've seen historically with the sale and trading of securities. But more broadly, what I think has happened from an innovation perspective, and this is kind of quite unique, is that this premature financialization of the space has shifted the focus of founders, entrepreneurs, investors in a way that has allowed a number of bad actors to blend in. It has facilitated all sort of great pump and dump schemes because people have taken these measures for granted. They think of these measures often as transparent reflections of the growth of a certain ecosystem, of a certain coin, of a certain platform. But ironically, in a space where everything can be measured, everything is transparently recorded on a public ledger, there's a dire need for better metrics. And my main argument in this short opening remarks is that for crypto to mature, for crypto to become actually a force for good, a technology that can be harnessed to democratize access to financial services, expand competition and innovation, we need to take a step away from these metrics. These metrics, again, are flawed, they're easy to game, and in fact, as we've seen, for example, with FTX or even with the Terra Luna stablecoin, insiders that understand how these metrics can be manipulated by, for example, controlling the supply of certain tokens, injecting capital to make the ecosystem appear much larger than it really is, have taken advantage of the general public and also of honest participants that are really trying to innovate and bring new technology to the market. So what is really novel here, and I think often the temptation in a phase like this is to kind of throw out the baby with the bathwater and just let crypto starve off, is that it is a technology that allows two parties to transact without relying on an intermediary. That doesn't mean that an intermediary shouldn't be involved in that transaction to begin with. Often the government regulators should be part of that transaction in some shape or form, whether it's for AML CFT concerns, sanctions, terrorism financing. There's a number of reasons why society has come up with frameworks to oversee transactions. So that may still be an important part of the picture, but we shouldn't, especially in this panel that focuses on the role of big tech, we should not forget that this is a technology that has the potential to change market structure. It has the potential to bring greater interoperability and competition to sectors of the economy that honestly haven't seen more competition in decades. To achieve all of that, I think the crypto industry needs better metrics, and we need to stop focusing on things that don't reflect actual progress. So if it is indeed a technology that can provide savings in the global movement of money, that can increase value for creators, entrepreneurs, workers that are working online and offline, by really reducing the cut that some of the middlemen take today in those transactions, then we should measure that. And I want to really close these opening remarks by essentially calling both regulators, policymakers, and also industry participants to work together to identify metrics that better reflect progress. Until we stop focusing on things like the price of a coin, the market cap, exchange volume and trades, crypto will always kind of perpetrate some of the failures that we've seen last year. Thank you. I look forward to the conversation with all of you.
Thank you very much, Christian. I would like to turn now to Nelly Lang for your introduction, please.
Okay, so thank you. Thank you for having me here today. on big tech and crypto, and I'm going to start with crypto as well before getting to big tech. A few words on some recent work that the U.S. Treasury with the financial regulators in the U.S. have been working on. We wrote a number of reports last year responding to the President's executive order on fostering responsible development of digital assets. And the report made a few distinctions that I think are important. One, unbacked crypto assets, which I think Christian called tokens, which we believe were mainly used for speculative trading. Two, stablecoins, which can be as a settlement asset in crypto markets and could be used more widely for payments. Three, a central bank digital currency, which could be a new type of central bank liability. And then fourth, the underlying technology, which may support innovation in clearing and settlement of traditional assets as well as digital assets. So with regard to the technology, Treasury has been supportive of exploring the potential benefits for the future of money and payments. New products could include well-regulated, securely backed stablecoins, some type of tokenized deposits, and central bank digital currencies. And these could enable instant payments, 24/7, atomic settlement, and programmable money. Potential applications include domestic and cross-border payments and settlement of tokenized securities. In contrast, the unbacked crypto products, the tokens, we found to be too speculative, too volatile to be used for payments. In the reports, we recommended that existing investor and consumer protection laws should be enforced rigorously to crack down on the fraud, abuses, and the conflicts, to protect consumers and to prevent financial stability risks from emerging. And where gaps in existing authorities exist, and there are gaps, we urged Congress to pass legislation. That was our take on crypto. I think it's actually quite consistent. We did not bring up the issue of proper measurement, but that is a good path forward. So this panel, though, is focused on big tech and crypto, and it's an intersection of a topic we've been talking about all day. These reports didn't specifically address the connection to big tech, but since we think the future value of crypto is for payments and not for speculative trading, the natural connection I'm going to make today to big tech is through payments and stablecoins. So in the US, unlike some other countries, big tech firms are not a dominant presence in payment systems. Apple Pay, Google Pay, for example, are among a large number of retail payment providers. They operate generally with partnerships with banks or offered directly through non-bank financial subs. Ultimately, the transactions are settled on interbank payment rails. Now, some of these firms, and including some big tech firms, appear to be exploring stablecoins, and we expect that, and where payments could occur outside the traditional payment rails. And so this potential combination raises a number of financial risks, as well as other policy considerations. So we analyzed the risks of stablecoins that could be used for payments in a President's Working Group report in 2021. We cited concerns about run risk, investor runs, and then redemption and operations risks. And that led us to some recommendations to establish a Prudential regulatory framework for stablecoins to ensure convertibility, as well as oversight of custodial wallets to ensure segregation of accounts. Another risk we cited, but is often less discussed, is related to their possible rapid scaling up because of network effects. And it's this potential combination of stablecoin with big tech, with its large existing user base, that makes this risk actually quite tangible and palpable. So we've discussed a few of the economic forces of payment systems and big tech today. Just to repeat a bit, first, both can exhibit network effects. That occurs when the value of the platform to an individual user increases when others also use the platform. So a social media platform is more useful to its users when they're the larger that the network is. And a closely related concept is strategic complements. And a strategic complement occurs when the actions of one individual depend positively on the action of another. So I'm more likely to send you a message on a social media platform. If you send me a message on the same platform, I'm more likely to use a stablecoin if you've paid me with that stablecoin. And we can see strategic complementarities across products. And that would be like the payment platform and the social media platform. If you pay me with a stablecoin on an e-commerce platform, I'm more likely to buy something with a stablecoin on that e-commerce platform. And in addition, we see that the user data that you glean from one line of business can support growth in another line. So as user activities grow, so does the amount of useful data that you can collect. So these factors, that's just running through them very quickly though, can lead to large existing big tech user bases for social media or e-commerce, could allow them to scale very rapidly in directly offering money instruments. This could lead to reduced number of retail payment providers and increased competition, reduced competition. In addition, the large-scale big tech and stablecoins, where stablecoins are not fungible with other kinds of money, could lead to kind of closed pocket economies, closed economies emerging, undermining the singleness of currency, and thereby also threatening monetary policy transmission. So that's just a number of things that we can start with and highlight. These obviously raise a number of policy issues, financial stability, competition. I just want to close by mentioning one, the concentration of economic power, which has come up in the US. In the US, there is a separation. There's not a doctrine. There's a separation of banking and commerce. It's been long held. It's existed since the country's founding, and it has limited to date the services that big tech platforms provide in financial services. It was motivated by a number of things and is still pretty held. Could be the risks of commerce spill into the banking sector. It could be that the banking would subsidize their affiliates, the commercial affiliates, and penalize competitors or give an unfair advantage to their affiliates. But there's also this general aversion to the kind of concentration of economic power that could result if banking and commerce were combined. That concern is still present. It might be a little different now. It could turn out to be that the e-commerce would subsidize a bank because of the data, and the bank itself is the less viable entity. But still, it is the same issue. And Mike Sue mentioned earlier today in 2015, perhaps Walmart wanted to open a bank, and there was a lot of concern about that in the country, and ultimately Walmart stepped back, has a partnership with the bank to provide some financial services, but in the end did not purchase a bank. So I'll stop there. Thank you.
Thank you, Nelly, for laying out those important issues from the US perspective. Rupert Sheffer, please.
Thank you, and thanks for having me on this distinguished panel. So linking big tech and crypto can seem quite paradoxical, given the original, maybe more anarchistic idea of crypto, which is leaving out actually the intermediaries and decentralized finance. But when I was preparing for this panel, at that moment there was media reporting that Twitter might be planning to include broader payment functionalities on its platform. And interestingly, these rumors actually did cause a short-term spike in a crypto asset called Dogecoin. So, so much on this link between maybe big tech and crypto. But maybe more seriously, I think big tech and crypto have really some characteristics in common. And I believe in combination, those two topics can really raise important challenges which should really warrant our attention. So in my remarks, I will share the perspective from an integrated supervisor, and I try also to include some practical experience with big tech projects. Before we talk about the risks, I think it's still important not to forget that innovation really is very important for the financial sector. So having new competitors, also having new products, new delivery channels, and also new technology can make the financial system more efficient. It can also deliver better outcomes for clients. So our role here as a supervisor is not really to protect the incumbents, not to define the market structures in a certain way, but we cannot be naive. We have to look at the risks. Risks for investor protection, but also financial stability. And those risks, I think they are real. So I do not want to repeat what has already been said about the specific characteristics related to big tech, in particular the network effects, issues for competition policy, data protection, monetary sovereignty, and so on. Maybe more on the side of crypto. Here, I think we clearly have to differentiate. First, crypto can relate just to the underlying technology. And there, I think distributed ledger technology can make traditional services more efficient. And there are also potential use cases in retail banking, in wholesale banking, but also in the financial market infrastructure. And this is not only for startup companies, but certainly also for incumbents, but potentially also for big techs. As a supervisor, I think our focus here would be on the specific risks stemming from this technology. And this has been discussed intensively. So this is in particular operational risk, including cyber, but also governance questions about the DLT platform, potentially also data protection issues. And then, of course, we have the unregulated sector in crypto. I would call it the Wild West. And those business models probably heavily rely on, fear of missing out. That's the maybe more unbacked securities or tokens, so-called stablecoins, which in the end are not so stable. And here I think the high-profile cases over the last 12 months have clearly shown the risks that are involved. Terra USD, but also FTX are really very clear examples, and also, I would say, spectacular failures in almost every part of governance, risk management, and control systems in the broader sense. And those failures are, I would say, are a strong reminder that the traditional regulation we have in place for banks, for other financial institutions, they make sense, and we should really fully apply those rules to business models that have the same risks. So here I think we just have to make sure that we close the existing gaps. And finally, there is, of course, a lot of activity and also excitement about decentralized finance, DeFi models. I think currently, if you look at those concrete cases, they are probably not so decentralized, and there is maybe some illusion around this. And there's maybe more some of an intransparent and indirect way of central controls. But if this idea or vision of a fully decentralized finance would become through, then it's clearly the opposite of a big tech, and it would raise also other questions that probably are beyond this panel, but also very important. Now, this brings me to some, I would say, key similarities between big tech and crypto, and you have alluded to this before. First of all, the speed of innovation and the speed of change of business models, and together with the potential growth due to the scalability of those business models. Second, I think there is potentially also global reach, combined, I would say, with a very strong appeal to digital savvy consumers, involving also social media and other channels. And there's typically a purely digital cross-border supply of those services. and not always a very clear, I would say, legal or physical domicile of those service providers. And probably there is also an underlying approach and culture of moving fast and breaking things, and we have heard from this this morning. So there are some, I would say, important implications for regulation, and I will later come also to supervision, but first on regulation. I think our rules really should be sufficiently broad and flexible. Otherwise, we cannot keep up with the speed of change here. And this means that the rules should be sufficiently broad. They should really follow the principle same risks, same rules, or at least same outcome. And I think we should also be prepared to adapt our rules quite rapidly if necessary. And then, of course, those rules should be based ideally on common international standards. And it's important that those standards are also consistently implemented, because otherwise I think we have potential for arbitrage, and we should close those gaps where they exist. I think a very good example here is the work by the FSB on crypto. As you know, here in Europe, we will have the MiCA regulation coming into force quite soon. But I think beyond this, we also need some sort of a more consistent global framework, and we also have some remaining gaps. For example, the pooling, the lending of assets, the whole DeFi activities, but also the combination of different services in one legal entity, capital liquidity requirements. So just some examples where I think further regulation would be helpful. Now, maybe moving on to supervision. And again, I think here's some interesting implications. And maybe let's just assume there would be another big tech project with a global reach. What would this mean for supervisors, and how can we approach such a project? I think it's very important that for supervisors, the task is really to apply the existing law. So if a new project comes up, you cannot just hide, you have to deal with it somehow. And this requires that you really understand the economics of such a project and the business model. And moving on from that, you have to really try to apply the existing rules in a flexible, maybe also in a creative way, so that you can address the relevant risks, or you have to make sure that those rules can be revised quite quickly. I think what's important, if such a project has the potential to grow very rapidly, that from the beginning you try to implement some, I would call it locks and keys, so that there are predefined requirements whenever the business model should expand in the future, and you keep some control to make sure that the relevant risks can be addressed. I would also say that it's very important to include a cross-border dimension here. And we have, I would say, as supervisors, we have very tested models for example, supervision of large institutions where we have colleges of supervisors. And I think you can define a governance to make sure that both home and host perspectives are included, to make sure that the spillover effects from such projects are addressed. And then, of course, there can be implications for other areas outside the financial regulation in the narrow sense, for example, competition, data protection, monetary policy. And typically for a supervisory authority, it's not legally possible to include all this in our own considerations. So there is not one authority with a holistic mandate. But I think it's still possible to make sure that, at least in terms of process, all the different competent authorities can move in parallel, and that you make sure that a new business can only start once the relevant laws are all complied with. And finally, I think that that's also important for integrated supervisor with resolution mandate. You should also think about a worst-case scenario where maybe this new business would not work out as envisaged. So there needs to be some sort of a predefined plan how you would wind down this activity. So I think all these elements, they can actually be found, for example, in the FSB recommendations for global stablecoins, which make them, I would say, a very good example that the international community can respond quickly also to new projects and new challenges. And maybe it's a bit of an irony that the Libra project, which was mentioned before, was not successful, but we have seen that some other stablecoins have grown quite exponentially, and they had maybe a little bit a different approach. They moved very fast and very quick, and even broke things even quicker. But they have been growing, and they are a reality now. So here, I think it would be important that we apply the relevant standards and also close the gaps where they exist. So I will stop here, and I'm sure we will come back to some issues later.
Thank you very much. So I'll have a round of questions for you, and then I think I'll open up the floor for questions as well. I'd like to turn to you, Christian. Libra that became DM, you were an important part of that project. I found it really interesting in your introduction, you said we need to find, you call it better metrics than the current metrics for the crypto world, if I might kind of interpret it like that. It would be really interesting if you would like to elaborate a little bit on that, and especially since you have these experiences and lessons learned from working on the DM project. How do we make it better, or how do you make it better?
On the lessons learned, I'm afraid that if I were to fully answer that question, it would conflict with your dinner plans. But jokes aside, I mean, some of the main takeaways, at least from a personal perspective of that 4-year journey, was that, you know, we went through a very intense set of interactions across the globe with a number of extremely thoughtful regulators, starting, of course, in Switzerland with FINMA, that convened a number of central banks and other agencies to really have that dialogue. We collected a lot of feedback in that process, iterated numerous times on the design. Regulators forced us, I think, and that was an extremely helpful process, to test our assumptions. We started with a white paper that had a number of major gaps. And to some extent, that process was really part of that engagement, and it really helped us, you know, improve that design. It helped us catch and essentially fix potential problems that could have emerged at scale. It made us better innovators from a number of technical, regulatory, and policy standpoints. It also closed the gap for that particular project between the technology and the more traditional expectations, I would say, of regulated financial institutions. So same risk, same regulation. And I think when I take a step back, to date, I mean, there hasn't been a more robust framework for stablecoins and crypto transactions than the one we proposed in the end of the process with DM. The Undersecretary emphasized a number of important dimensions, and I think the Presidential Working Group actually captured many of the choices that we had made in reserve design and in kind of openness of the ecosystem that we were proposing by the end of that journey. So on the one hand, you know, the conclusion might be that crypto participants, including large tech companies, should really embark on that same journey the way we did. The project, you know, was substantially better as a result of that process. At the same time, you know, I caution from drawing that conclusion because, as many of you in the room know, the project in the end was not evaluated on its merits or on its challenges. And I do find it somewhat ironic that, you know, while everybody was worried about a project that was proposing a small scale pilot with all sort of gates to its growth, you know, starting thousands of users, not millions, that really iterating in collaboration with regulators was the one that attracted all the concerns, while on the sidelines, you had ecosystems like Terra Luna literally growing in the billions without any type of oversight. And again, to the Undersecretary concerns, I do see a potential for the stablecoin ecosystem to lead to some degree of concentration. I mean, right now, if you account, even for the stablecoins that are somewhat regulated, for example, at the state level, of course, not federal in the United States, and exclude the offshore ones, these are starting to look more like walled gardens, ecosystem of their own that essentially switch, you know, one closed loop network with another. And so I think it's really important that for crypto to not only develop those better metrics, but really grow in a constructive way, that we find a way to have that dialogue again between regulators and policymakers and some of the industry participants. I feel like because of the events of 2022, again, some might be tempted to just further disconnect crypto experiments from the existing financial system, almost as to starve off the industry. I think that would be actually quite counterproductive. The technology in and of itself is not going to go away. If you look at history, it never does. It might be slowed down, it might not be really stopped. And so the main takeaway for me is that we need to raise the bar for crypto participants. We need to make sure that entities that scale reflect all those concerns, from financial stability to consumer protection to competition, so that actually the technology can be used for its positive potential rather than in a destructive way.
Thank you. That was a very comprehensive list of things to be mindful of. So makes a lot of sense to turn to you then, Nelly, and think about stable coins issued, and certainly stable coins issued by potentially then big techs. So the report issued by the President Working Group recommends the Congress to basically make sure that stablecoin issuers are insured depository institutions. And if you think about that, it makes it really difficult for big techs to issue stablecoins. Is that the right way? I'm assuming you're thinking about that is the right way forward. Why is that the right way forward, and what do you think will happen if that doesn't become a reality?
Yeah. So as I mentioned, the report identified 3 risks in particular: the run risks, the operation and redemption risks, and the risks of scaling up very rapidly. And Diem was, an example of one that could happen. And with that, the proposed recommendations were for a prudential regulatory framework, not regulated as a money market fund, which only may be concerned about the security of the assets, but also some operational risks. And so there would be some kind of capital, some kind of liquidity, perhaps not like an insured, as if it were insured deposits, but it would be like a prudential regulatory framework. I think we still believe, with the events of last year, this is still the same path forward. Some legislation had been proposed based on the PWG report. We've worked with Congress on requests to keep working at it. The new Congress, even with changing to a Republican administration, is still very interested in moving forward on it. I think it is important. I think Christian mentioned working to make sure that compliant with the Bank Secrecy Act, all the AMLs, BSA, AML, that's like a given. That's like, we just need to have good, sound regulations on that. In the United States, many of these stable coins could just be state. They could have state money transmitter licenses and operate, which do not provide a regulatory framework. And so the new one would require some kind of federal thing. Diem came very close. I don't think you actually had an application. I don't think there was an application denied. I think there's just a lot of work that went into the process. And in the end, just decided not to go forward with the model you had at the time. But as you said, there are others working on this. And I think the US, the federal regulatory agencies, and the Congress want to have a framework in place and not sort of catch up like they have been in terms of the tokens.
Thank you. Rupert, when you think about big tech and crypto, they can play 2 different roles. They could be crypto asset issuers, but they could also be service providers. How do you think around these potential 2 work streams, or what kind of expansion possibilities that can come from the big tech world? And since you are from a European Union country, We have regulations coming in, MiCA. Is that fit for purpose, or do we have to start to think about an updated version already?
Well, thanks. Well, first of all, I think it's a possibility. Of course, if you look at the economics behind platform business models, this could fit into this ecosystem, both issuance of tokens, of assets of different kinds, not only stable coins, but also digital asset service provider. So I think it's important that we have a framework which is fit for purpose. I would say that MiCA is really a big step ahead, and is very much welcome. It's, I think, very aligned with the international standards. But as I said before, the markets are developing also, and there's some innovation. So we think that some updates would be helpful, certainly, in particular for business models which try to combine different elements in one legal entity or under one roof. There, I think some more meaningful capital or liquidity requirements would be helpful, and maybe some other elements that could be an evolution of this act, or could come through supervisory requirements.
Okay, thank you. So I'm going to open the floor for questions. And I saw at a previous session there, yes, I have a member of staff who has microphones too, so you should come well prepared. And while you are thinking about a question, let me turn back to you, Christian, and this issue around what big techs are up to in the crypto space. From what we understand, what I understand, that some big techs are making sizable investments in blockchain companies. We heard that Samsung is reportedly considering launching a cryptocurrency exchange. What do you make out of this? Are we just in the beginning of seeing a large big tech companies' involvement in the crypto space, or are they still playing sort of with their cards close to their chest?
Again, I don't have any special insight, but my understanding of what's happening is that right now everyone is reconsidering their priorities, not just in crypto, but as you've seen, tech firms are busy doing layoffs and really refocusing on their core business, cutting costs. There's a lot of enthusiasm around AI, actually, and that seems to have taken over the narrative that was on crypto. I think that's all positive. When it comes to crypto, my hope is actually that the focus will shift away from hype, speculation, some of the things we've seen even around non-fungible tokens, and towards technology that can actually solve real problems. Taking a step back, again, this is a technology from an economics perspective and from a network effects perspective that is really well designed for bringing more interoperability and competition to digital platforms. And I think although it's still early stage, we're seeing the birth of new protocols around messaging, around social media, around two-sided marketplaces. It's a little bit like the early days of the internet again. A lot of this has happened behind the scenes and hasn't attracted a lot of attention. But this is a real threat to established network effects and tech players. The same way we've seen AI over the last few days really reopen areas such as search that were considered uncontestable. Now you have, again, Microsoft with OpenAI challenging Google's leadership in search. We have to remember that network effects, especially today, are extremely, extremely fluid. Think about the quick rise of platforms such as TikTok, taking over a lot of the engagement that was captured by other players. So I think in the medium to long term, crypto will definitely change how we consume, how we aggregate, how we monetize digital content. And I'm actually quite hopeful that the underlying economics will bring more choice and competition, whether it's to the creator economy or to other two-sided marketplaces in ride sharing, in music, in a number of sectors that are currently fairly concentrated. It's a technology that forces incumbents to really rethink how they stay relevant. And so I think actually, if you were to take a step back and look at this technology, much more like open technology standards, there's a long-standing literature in academia around the role of open standards in innovation. And I think that can be channeled by regulators and policymakers to actually get some of those competitive outcomes that they want to see in all of these markets. So think of the technology more as an opportunity rather than a threat, and as a way actually to bring back a leveling playing field in many of these sectors of the digital economy that have become more concentrated over the last few decades.